Livermore's discipline test is far from a rigid checklist of arbitrary rules. Instead, it represents a deep intuitive understanding of market dynamics combined with an unyielding self-control. This test rigorously scrutinizes a trader's intrinsic capacity to master innate human emotions, fear, greed, hope, and panic, which perpetually drive, distort, and ultimately manipulate market behavior. These primal forces often cloud judgment, leading to impulsive entries, premature exits from profitable positions, or stubbornly holding onto losing trades with irrational optimism. The core tenet of this profound test is clear and uncompromising. The market is never wrong in its movements. Only a trader's interpretation and subsequent actions, based on their flawed perceptions, can be incorrect. This isn't a passive acceptance of market volatility, but an active commitment to align one's perspective with the objective reality presented by price action, rather than imposing preconceived notions. This crucial distinction is paramount for anyone seeking enduring success in speculative ventures across any asset class. The market, in its essence, is a dynamic reflection of collective human psychology, consistently presenting both lucrative opportunities and treacherous pitfalls for those who are unprepared or emotionally compromised. Livermore understood with remarkable clarity that while the specific faces and names of market participants may change over time, the underlying human nature that fuels market movements remains constant and predictable. The collective fear and greed, the pervasive hope for quick riches, and the widespread panic during significant downturns are eternal drivers, regardless of technological advancements or regulatory shifts. His test, therefore, compels disciplined traders to look beyond the immediate noise and fleeting short-term trends, focusing instead on the enduring universal principles that govern genuine price action. It demands an objective, almost detached perspective, entirely free from the emotional biases that so often lead to irrational, costly decisions. This detached observation allows for clearer judgment. One of the foundational principles of disciplined trading, according to Livermore, is the absolute necessity of relying solely on one's own independent analysis and sound common sense. He vehemently cautioned against succumbing to external tips, unverified rumors, or the unsolicited advice of others, no matter how convincing or authoritative they might seem at first glance. This independent thinking cultivates genuine conviction, which is essential for decisive action, preventing the herd mentality that often leads to collective irrationality and subsequent losses. True conviction, he firmly believed, must stem from one's own diligent observation and logical deduction, enabling a trader to act decisively and without hesitation when the market objectively confirms their thesis. The market invariably moves along the path of least resistance, and this path is often precisely defined by the subtle interplay of supply and demand, which astute observation can reveal, guiding entries and exits with precision. The disciplined trader's paramount task is to observe this path, not to predict its exact trajectory or to argue with its undeniable direction. Furthermore, Livermore meticulously emphasized that the primary objective is not to buy at the absolute bottom or sell at the absolute top of a market cycle, but rather to enter positions at the opportune moment when the market itself definitively confirms the intended direction. This often means waiting patiently for a clear, unmistakable signal, even if it implies missing the very first, often volatile part of a significant move. This practical approach means waiting for confirmed breakouts from established consolidations or clear trend continuations, rather than attempting to catch falling knives or buy into unconfirmed speculative reversals. Such disciplined patience actively prevents premature entries based purely on hope or speculative impulse, drastically reducing the likelihood of immediate, frustrating losses. It's fundamentally about being right with the market's current observable trajectory, not about attempting to forecast its exact elusive turning points with impossible accuracy. A critical component of Livermore's comprehensive discipline test revolves around stringent position and risk management, which he considered non-negotiable for long-term survival. The first rule, unequivocally and without exception, is to cut losses quickly. This means exiting a losing trade without any hesitation or emotional attachment, acknowledging that a small controlled loss is a necessary and unavoidable cost of doing business in the markets, far preferable to allowing it to escalate into a catastrophic, account-crippling one. This rule serves as an impregnable protective shield for capital, ensuring that no single mistake or misjudgment can critically impair one's entire trading account. Emotional attachment to a losing position, fueled by an irrational hope that it will miraculously reverse, is a direct and well-worn path to financial ruin and a blatant, unforgivable failure of discipline. Conversely, the disciplined trader must possess the rare fortitude to let profits run. Once a position moves into profit and the market continues to behave exactly as expected, the natural temptation to take small, quick gains must be consciously and consistently resisted. It demands the mental strength to resist the urge to lock in small, immediate profits, recognizing with clarity that the biggest, most substantial profits come from patiently riding established, sustained trends for their full duration. Significant wealth in trading is accumulated by capturing these large, overarching market movements, not by scalping minor, insignificant fluctuations. This requires immense patience, deep conviction, and unwavering confidence in one's initial, well-researched analysis, allowing winning trades to mature and deliver their full potential. It's about riding the prevailing trend until the market signals a clear, undeniable reversal, not until one's emotions dictate a premature exit. Livermore also sagely advised against attempting to capitalize on every minor fluctuation or insignificant oscillation in price. His strategic focus was intently on identifying and participating in major, overarching market swings, where truly substantial profits are reliably generated. Chasing every small move often leads directly to overtrading, incurring increased transaction costs, and ultimately resulting in diminished returns and increased psychological fatigue. This selective approach is crucial for maintaining sharp focus and actively avoiding the pervasive trap of overtrading, which often erodes profits through cumulative commissions and increased, unnecessary exposure to random market noise. The disciplined approach invariably involves waiting patiently for clear, significant opportunities to present themselves, rather than constantly being active and engaged in the market without a compelling reason. This judicious approach conserves both precious capital and vital mental energy, allowing for sharper, more decisive decision-making when truly impactful opportunities eventually arise. Another cornerstone of his profound methodology was the inviolable principle of never entering the market until it explicitly and unequivocally confirms your initial thesis. It is always strategically better to be slightly late to a confirmed move, entering after the market has provided clear validation, than to be early and consequently wrong. This discipline actively prevents impulsive trades based on mere speculation or wishful thinking, ensuring that capital is deployed only when the objective odds are demonstrably in the trader's favor, thereby minimizing unnecessary speculative risk. This patient, confirmatory approach significantly reduces the inherent speculative risk associated with early entries. It mandates that a trader waits for conclusive price action to validate their analysis, providing an objective green light before committing any capital. This strategic waiting game is a true and revealing test of a trader's patience and emotional control. Position sizing for Livermore was not merely a dry mathematical exercise, but a deeply personal emotional one. He famously advocated for determining a position size that allows a trader to sleep peacefully at night. This profound statement illustrates the deep and intrinsic connection between prudent capital management and psychological well-being. This principle underscores the critical importance of managing risk at a personal psychological level, ensuring that financial stress or anxiety does not compromise analytical judgment or emotional resilience. If the sheer size of a trade induces anxiety, stress, or disturbs one's sleep, it is almost certainly too large, clearly indicating a lack of emotional control over one's capital. The ability to remain calm, rational, and objective, even with open positions in a volatile market, is a hallmark of true trading discipline and self-mastery. Furthermore, Livermore meticulously practiced and passionately preached a method of gradually increasing a position, often referred to as pyramiding. He would strategically initiate a small probing position, and if the market subsequently moved in his favor, he would judiciously add to it at specific, predetermined price points. This sophisticated strategy not only allowed him to build a larger, more impactful stake in a winning trade, but also served as a continuous objective validation of his initial thesis as the market confirmed his view. This method, known as pyramiding, allows a trader to build a substantial position in a winning trade while minimizing initial risk, effectively using ongoing market confirmation to justify increased exposure. This cautious incremental scaling also prevented him from drawing undue attention or significantly influencing prices with a single massive initial order, a crucial consideration for a trader of his scale. Psychological resilience and unwavering patience are perhaps the most challenging, yet undeniably crucial elements of Livermore's comprehensive test. He stressed the absolute necessity of developing an emotional detachment from transient market movements. A truly disciplined trader must never under any circumstances argue with the tape, meaning the live stream of prices and volume, which represents objective market reality. The tape presents the undeniable objective truth of the market. Arguing with it is akin to arguing with gravity, an exercise in utter futility leading only to inevitable and unnecessary losses. One's personal opinions, hopes, or biases must never override its undeniable objective message. This objective acceptance of market action, regardless of one's personal bias or prior expectations, is absolutely fundamental to disciplined trading. Patience, in Livermore's view, was not merely a passive virtue, but a dynamic strategic imperative. He often highlighted the immense importance of waiting for weeks, sometimes even months, for truly clear, compelling, and high-probability market signals to unambiguously emerge. This means actively accepting that the very best opportunities are inherently rare and require extensive, disciplined waiting, rather than forcing trades out of boredom, frustration, or an insatiable desire for constant action. The pervasive urge to trade daily, to constantly be active and engaged in the market, is a common and destructive pitfall that leads directly to impulsive decisions and unnecessary losses. Successful speculation, he argued, frequently demands long, disciplined periods of inactivity, observing, analyzing, and patiently waiting for the opportune moment to strike with surgical precision and unshakable conviction. He recognized that speculation is an inherently complex, demanding, and unforgiving endeavor, requiring continuous intellectual rigor, unwavering emotional stability, and an acute self-awareness. It offers no quarter for mental laziness, emotional volatility, or casual engagement. Those who approach it casually or allow their emotions to dictate their actions rather than their carefully constructed plan are destined for inevitable and repeated failure. It demands continuous self-awareness, a readiness to adapt to evolving market conditions, and an unwavering commitment to one's chosen methodology, actively weeding out the casual and the undisciplined. The market is an unforgiving arena that mercilessly exposes every weakness in a trader's character and methodology, making self-mastery an ongoing, non-negotiable requirement for long-term survival and success. Livermore also underscored the critical importance of periods of complete withdrawal from the market, recognizing their strategic value. There are often times when market conditions are unclear, highly uncertain, or a trader's personal emotional state is compromised, making it profoundly prudent to simply step aside entirely. These periods of sitting on one's hands are not failures of discipline, but rather powerful demonstrations of it, a strategic choice to preserve capital and mental energy. These periods are not idle time, but essential for mental rejuvenation, objective reflection, and strategically preserving capital during uncertain or unfavorable market conditions, allowing for a tactical retreat and a thorough re-evaluation. Knowing precisely when not to trade is as vital, if not more so, than knowing exactly when to trade. The timeless wisdom of Jesse Livermore, particularly his profound insights into market psychology and disciplined execution, remains incredibly relevant and impactful today. For those seeking to deepen their understanding of how market dynamics truly unfold beneath the surface, and to internalize the mental frameworks of legendary traders, there is an invaluable resource that bridges the past and the present. The new edition of Edwin Lefebvre's classic, Reminiscences of a Stock Operator, offers far more than a mere historical account of Livermore's life and trades. It provides a unique, modern interpretation of Livermore's experiences, replete with insightful commentaries and detailed chapter-by-chapter breakdowns. This isn't just a book to be read. It's a practical guide that distills Livermore's psychological journey and strategic brilliance into actionable lessons for contemporary traders. It meticulously dissects his triumphs and his inevitable failures, revealing the universal principles of market behavior and self-mastery that are as potent now as they were a century ago. By transforming his raw, often brutal experiences into structured, practical lessons, this edition empowers you to apply Livermore's profound understanding of human nature and market cycles to your own trading decisions. If you are serious about elevating your trading discipline and gaining a strategic edge that stands the test of time, this book is an indispensable tool for your arsenal. Find the link in the description below to secure your copy and begin your transformative journey into the mind of a true trading legend. Applying Livermore's test in modern trading requires a structured, systematic approach, starting with the indispensable practice of maintaining a detailed trading journal. This journal serves as an objective, unbiased record of every trade, meticulously documenting entry and exit points, the precise reasons for the trade, your psychological state at the time, and the ultimate outcome. It fosters crucial self-accountability and transforms subjective trading experiences into objective data points for systematic improvement, effectively acting as a personal performance audit. Analyzing this invaluable data allows traders to identify personal patterns, recurring mistakes, and successful strategies, fostering continuous learning and iterative improvement. It transforms what might otherwise be subjective anecdotal experience into objective actionable data, providing a robust foundation for consistent self-correction and refinement. Objective metrics are absolutely crucial for assessing true trading effectiveness and moving beyond anecdotal evidence. Beyond simple profit and loss figures, disciplined traders diligently track their win rate, their average risk-to-reward ratio, RR, and their mathematical expectancy. These metrics collectively provide a clear, unbiased picture of a strategy's long-term viability and robustness. These quantitative measures provide an unbiased evaluation of strategy effectiveness, helping to accurately distinguish between fortunate, lucky streaks and genuinely robust, repeatable trading approaches. A high win rate combined with a poor RR might still lead to overall unprofitability, just as a low win rate with an excellent RR can be highly lucrative over time. Understanding and actively managing these critical numbers helps refine one's approach and ensures that the underlying strategy is statistically sound and sustainable. While the tools and technology of trading have evolved dramatically since Livermore's time, from rudimentary chalkboards to sophisticated high-frequency algorithms, the underlying human psychology that drives market behavior remains fundamentally unchanged. Adapting Livermore's philosophy means applying his core principles of self-control, unwavering patience, and objective observation to modern instruments, diverse markets, and advanced trading platforms. While technology undoubtedly changes the speed and accessibility of execution, it does not alter the underlying psychological forces of fear and greed, making Livermore's insights timeless, universally applicable, and perpetually relevant. The core battle against innate human fear and greed, the persistent need for independent, unbiased analysis, and the fundamental discipline to manage risk effectively are universal, regardless of the specific technology employed or the market traded. Continuous self-improvement is not just a recommendation, but an absolute mandate for disciplined trading, a lifelong commitment. This involves constantly refining one's ability to intuitively read nuanced price action, deeply understand the complex dynamics of supply and demand, and develop an almost intuitive feel for prevailing market sentiment. This includes staying rigorously updated with evolving market structure changes, understanding the profound impact of new technologies, and consistently refining one's analytical edge through dedicated study, deliberate practice, and ongoing critical self-assessment. It's about perpetually sharpening one's observation skills, learning valuable lessons from every single trade, and staying highly adaptable to ever-changing market conditions. The market is an inherently dynamic and constantly evolving entity, and a trader's learning journey should be equally dynamic, never static or complacent. Several common pitfalls frequently derail even well-intentioned and initially promising traders, and Livermore's enduring principles offer clear, actionable guidance on how to avoid them. One major trap is attempting to incessantly predict short-term market movements without establishing robust capital and money management protocols. Such endeavors often lead to chronic overtrading, emotional exhaustion, and significant capital erosion, as the short-term market is largely characterized by random noise, making consistent prediction an elusive and ultimately futile pursuit. This often leads to excessive leverage and devastating losses when predictions inevitably go awry. True discipline focuses relentlessly on managing the probabilities and meticulously preserving capital, not on possessing infallible foresight. Ignoring fundamental principles of risk management is another prevalent and catastrophic error. Many traders, driven by the intoxicating allure of quick riches and instant gratification, take on disproportionate risks relative to their available capital, violating basic tenets of prudence. This critical oversight stems from an often irrational desire for rapid wealth accumulation, bypassing the fundamental principle of capital preservation, which is the absolute bedrock of long-term survival in the volatile world of trading. This often results in blowing up accounts, effectively ending their trading career prematurely and permanently. Livermore repeatedly demonstrated through his own experiences that preservation of capital is paramount, and aggressive, uncontrolled risk-taking without a strong, validated edge and strict controls is an undeniable recipe for disaster. Succumbing to emotions rather than steadfastly adhering to objective trading rules is perhaps the most insidious and destructive trap. Fear causes premature exits from potentially winning trades, while greed leads to holding losing trades far too long, hoping for an impossible recovery. Hope keeps traders irrationally committed to positions that should have been closed decisively, and panic induces irrational, often capitulatory selling at the worst possible moments. This mental lapse leads to impulsive decisions that deviate sharply from the rational, predefined trading plan, turning a strategic approach into a reactive, emotionally driven gamble. Discipline means having a clear, predefined set of rules and the mental fortitude to execute them flawlessly, consistently, and without exception, irrespective of fleeting emotional impulses. Overtrading, often born from an acute lack of patience or an insatiable desire for constant action, is a significant drain on both capital and vital mental resources. Constantly being in the market, even when clear, high probability opportunities are conspicuously absent, racks up excessive transaction costs, and exposes precious capital to unnecessary, uncompensated risk. This common affliction stems from a deep-seated psychological need for constant action and engagement, leading to unnecessary exposure to market risk and the gradual erosion of capital through accumulated transaction costs. Livermore's profound emphasis on waiting patiently for obvious, confirmed signals directly counters this destructive tendency, advocating strongly for quality over mere quantity in trade execution. Finally, the absence of a clear, meticulously defined trading plan and the unwavering discipline to adhere to it is a surefire path to inconsistency and eventual inevitable failure. A comprehensive trading plan meticulously outlines precise entry and exit criteria, robust risk management rules, and judicious position sizing guidelines. Without such a well-defined blueprint, trading becomes an unstructured, arbitrary, and highly reactive activity, making consistent profitability virtually impossible to achieve or sustain. Without a meticulously defined strategy and the strict discipline to adhere to it, trading becomes an unstructured, arbitrary activity, making consistent profitability virtually impossible. Discipline is the crucial bridge between merely having a plan and actually executing it consistently and flawlessly. In summary, discipline in trading is not an inherited trait or a stroke of luck, but a meticulously cultivated skill, forged through the conscious, consistent, and unwavering application of fundamental principles. Jesse Livermore's test serves as a profound and enduring framework for this continuous development, challenging traders to constantly refine their market understanding, emotional control, and precise risk management. It is an ongoing internal journey demanding continuous self-assessment, critical reflection, and persistent improvement. By embracing these timeless tenets, traders can transcend mere speculation and evolve into true professionals, capable of navigating the market's inherent complexities with poise, calculated precision, and consistent profitability. Embrace Livermore's challenge. Let it guide you towards a more stable, more profitable, and ultimately a more fulfilling and sustainable trading career As you continue to sharpen your trading acumen and seek deeper insights into the fundamental structures and behaviors of financial markets, consider exploring methodologies that powerfully complement Livermore's astute observations on market behavior and manipulation. The Richard Wyckoff Trading Methods channel offers a dedicated, comprehensive platform for an in-depth study of Wyckoff's seminal principles, including the critical analysis of accumulation and distribution cycles. Understanding these powerful cycles provides a structured, analytical framework for accurately identifying the often hidden footprints of smart money and anticipating significant market turns with greater confidence. This offers a powerful analytical lens that aligns perfectly with Livermore's emphasis on reading the market's true intent and underlying forces. This channel can significantly enhance your ability to interpret complex price and volume action, giving you a more comprehensive strategic view of distinct market phases. Check out the Richard Wyckoff Trading Methods channel. The link is conveniently located in the description below. To further your journey into advanced institutional-level market analysis, implement these principles, commit to the rigorous process, and watch your trading transform. The path to consistent, enduring success is unequivocally paved with unwavering discipline.